The 2008 stock market crash refers to the sharp decline in stock prices that occurred in 2008. It was one of the most significant stock market crashes in history, and it had a severe impact on the global economy. The crash was triggered by the collapse of the housing market, which was fueled by risky subprime mortgages and lack of regulation. Banks and financial institutions had invested heavily in these mortgages, and when homeowners began defaulting on their loans, these institutions found themselves in financial trouble. This led to a domino effect, causing many banks and other financial companies to go bankrupt and leading to a credit crisis. The stock market, which had been rising for several years, began to plummet, and investors panicked as they saw their savings and retirement accounts lose value. The crash ultimately led to the Great Recession, a severe economic downturn that lasted for several years and had a significant impact on the lives of millions of people around the world. The causes of the 2008 stock market crash can be traced back to the housing market, which was driven by risky subprime mortgages. These mortgages were given to borrowers with poor credit, and many of them had adjustable interest rates that would increase after a few years. This meant that many homeowners would eventually be unable to afford their monthly payments, and they would default on their loans. The banks and financial institutions that had invested in these mortgages found themselves in financial trouble as a result. This was compounded by the lack of regulation in the financial sector, which had allowed these risky practices to continue unchecked. Additionally, the widespread use of financial instruments known as credit default swaps, which were essentially insurance policies on these mortgages, had created a complex web of financial interdependencies that made it difficult to understand or manage the risks involved. The effects of the 2008 stock market crash were far-reaching and severe. The stock market lost trillions of dollars in value, and investors saw their savings and retirement accounts lose value. The crash led to the collapse of several large banks and financial institutions, including Lehman Brothers, which triggered a credit crisis that spread throughout the global economy. As a result, many businesses and individuals found it difficult to access credit, and this had a negative impact on economic growth. The recession that followed the crash led to high levels of unemployment, and many people lost their jobs. The housing market also suffered, with prices falling sharply and many homeowners owing more on their mortgages than their homes were worth. The crash had a significant impact on retirement savings, as many people saw their nest egg shrink. In addition to this, the crash led to changes in banking regulations and a greater focus on financial stability and oversight. So this was the introduction to 2008 stock market crash, and we will discuss its causes in second part. Don't forget to subscribe the channel and smack the bell button to get the notification for second part.